RBC has been our underwriter here in Douglas County since at least 2006, probably many years prior to that. And they're always looking out for those opportunities to save our taxpayer dollars. So they've precipitated this effort, and I'd like to turn it over to Dan O'Connell to give you the details about the success of our sale.
Thank you. Do you guys have known it? Did you get this in the? Okay, great. If you guys could turn to this memo, you probably have it in your board packets. If you recall, last year we refunded the remaining or some portion of the 2006 and 2007 general obligation bonds. This is a refunding of the remaining callable maturities. As Bonnie noted, we have continuously monitored the interest rate market. There's a parameters resolution that was approved by the board, which basically allows RBC to monitor that market and when it's in the best interest of the district and the district's taxpayers to refund those bonds. The remaining portion of those bonds were refunded on January 31. And I'm going to give you a brief summary, and I'd be happy to answer questions. I know you have seen this before, but there were some impressive results here, significantly pointing toward the underlying rating of the district, which is a AA1 from Moody's, AA plus from Fitch. Oftentimes you hear us mention that when we come to these board meetings and talk about underlying ratings and what are the importance of it. It's hard to differentiate between the AA1s, AA2s, and what does that really mean. The day we marketed, there was also another issuance by Pueblo School District, which is just one notch lower, so a AA2 versus a AA1 from Moody's. And that one notch, essentially, they marketed their bonds 15 basis points higher, so at an average interest rate of almost 3.15%, whereas ours was 2.99%. So what does that mean? That means that to the district, that meant an additional $692,000 of taxpayer savings. So that's why you maintain a healthy general fund. That's why you have strong financials in place so that you can see this come into effect when we actually refinance the bonds or when we go for new money issuance. So that's really the reason behind, you hear the AA1, AA2, and what does that all mean? That on paper, that's what it means. And it was just, you typically don't see another school go at the same time, so this gave us a really good comparable on that day. And I think it provides good evidence to why we maintain those ratings. The average interest rate on the bonds that we did refund was 5%, so that was done in 2006 and 2007. Interest rates were higher, and now they have come down to all-time historical lows. As you know, they're starting to go up a little bit, which is why it's really good that we were able to pass the parameters resolution in time to give us plenty of time to enter the market on an efficient timeline. The bonds that we refunded were 5. We refunded them with bonds of 2.99%, so sub 3%. That goes all the way out to 2030. That's a difference of 201 basis points. So the bottom line, what that means is gross taxpayer savings of $1.709 million. So that's over the course of the next, essentially through 2030. That's about $110,000 of savings per year. If you combine that with the refunding, as you may recall we did early of last year, that's over $5 million in gross savings to the district's taxpayers.